Hello, my friend. Welcome to the True Secret Sauce series.
We are continuing with the lessons on monkey bars. We discussed about value area, point of control. Value area is really the 70% of the trading happened. The point of control. We saw the significance of having a congestion of point of controls or the value area and how to use that for our benefit. We also looked at how an ideal chart should look like. What is a poor high or a poor low means and how to make that useful in our trading decisions. Now I'm going to go through double or triple distribution. First, let me show you the chart. When some news or event happens and suddenly the stock moves big, as an example, let's say the Fed announces and the bonds shoot up or shoot down. In our case, we'll assume that's going up, and what happens is some events trigger and the stock prices start going up very fast. It does not have time to take a breather like here where you have a lot of price action has happened. But look at here, the price quickly moves past the price points, tries to stabilize here, and then again starts quickly moving up and keeps going up and up and up. The stock had opened up here and closed all the way here. In that way, it's also formed a distribution here. It is actually, think of it like a tail. So it has formed a tail here, it has formed another tail here. So this is not even a double distribution, it's considered to be a triple distribution because you can segment one portion of the trade here, the second portion of the trade here, and the third piece is here. So this is considered as a triple distribution. In our case, you should treat a double distribution as two successive up days and a triple distribution as three separate up days, and set up your trade accordingly.
Now we are into the fourth and very important quadrant. Notice the mountains in these charts. Each of these peaks represent the total volume of trades happened at that price point. For example, the huge mountain at about 240. So lots of trade has happened at this price point, and a lot of traders have an inherent interest to keep the prices above these mountains. So what happens is, since the volume was very high at a particular price point, those price points tend to become a good nice floor and high resistance, and the price generally does not breach that price point easily. So it becomes like a nice floor. So when we trade, you have to look at these mountains and see, hey, there is a high peak, so your stop loss could be right below that, and you can see where we are in the chart from a mountain perspective. And notice there are a lot of troughs here. I've marked it in green, and these are where the prices had quickly moved past these points. For whatever reason, the prices either went down or up and did not stay here for long, and there are only very few traders who have interest to keep the prices around these regions. So what will happen is, whenever there's a small trough, you can be rest assured that most likely, if and when these mountains are breached, it will quickly breach these points also. So if it falls, let's say the price falls from here, what happens is more than likely It might slow down here a little bit, but then the big mountain is now at about 238. So this is what you have to look at it. So the peaks represent a nice resistance and the troughs represent weak points which will quickly get breached. Also notice that alone I'm putting a little less time frame because we don't want a 1 year time frame, and notice the peaks because what we want to know is on a shorter time frame how to protect our positions or how to trade accordingly. This will basically conclude the 4 quadrants, and I'm going to show you how to set up that. Just go to the quadrant and add what is called as volume profile. I'm going to show you in the chart right now. So this is how you set up. So basically I have a 30-day chart and the volume bar is there. Just to let you know, I have removed all those volume subgraphs, and it also shows I have disabled the show extended hours trading session just so that it looks cleaner in our chart. So to conclude, between these 4 important quadrants, there is a good chance you are going to capture the direction correctly. I summarize this as a 1% advantage. Remember, I do not call it as a big advantage because market has a way to always trick the best intentions. This is a 1% advantage, nothing more, nothing less. A small 1% edge that we have to capitalize across multiple trades over multiple months, multiple years, and multiple decades. Happy and safe trading, my friend.